Produzione Corax, social media company.
Welcome back to The Bull. It's a pleasure to have you with us again. We last spoke about a year ago, but it feels like a decade has passed rather than just 12 months. 2025 will likely go down as one of the most regime-changing years in modern market history.
Well, it could be more than 1 year that the regime change. The new Fed chair is talking about regime change, so
yeah,
be interesting. Not just market history, geopolitical history.
Yeah, 2026 doesn't look any less eventful. In fact, if anything, it seems unlikely to be a boring year.
Yeah, might be calmer. Maybe we just got used to the chaos.
Yeah.
Okay, I'm ready whenever you are.
I'd like to structure our conversation by walking through the major asset classes, so equities, bonds, gold, and the dollar. But before we dive into markets, there's a question I've been wanting to ask you for a long time, because you are arguably one of the most successful macro forecasters of the past 5 to 6 years, at least since the global pandemic. You made great calls with a strong
read my book, Predicting the Markets. It's on the website
2018
as a PDF, and you'll see that the record goes further back than that.
Yeah. I was saying that the track record extends back to the global financial crisis, at least.
Well, to the early 80s.
Wow, wonderful.
Yeah.
So I was understating it. I often tell my audience that forecasting in finance is extraordinarily difficult, and that they should be skeptical of anyone who claims to truly understand what's going on, except when it comes to Ed Yardeni, because you're clearly the exception. The professor rule.
It's not that difficult if you keep it simple.
What's the secret sauce?
I think a sense of history is kind of important. I mean, as they say, history doesn't repeat itself, but it rhymes. So I think that's important. A bit of a contrarian streak when everybody's convinced that something has happened. It's time to think about why they might be wrong. So that helps quite a bit. Spend a lot of time and written a couple of books on the Fed. I think the Fed is extremely important. Most investors view the market as individual stocks, and they're often surprised by macroeconomic and geopolitical events. So that helps. I think also what I've done uniquely is I'm a strategist and an economist. On Wall Street, it's two separate roles.
Okay.
And they have to kind of get along with each other. And when they don't, they disagree, and it's kind of embarrassing. I don't have that issue. I don't have to conform to the views of the house views of either an economist or a strategist. So having that freedom is liberating, really. And I like the Fed says they are. I'm data dependent rather than model dependent. Warsh, or I agree with Warsh that the Fed is got too much dependence on their models, particularly as he said, the Phillips curve model. On the other hand, Warsh says that he criticizes the Fed for having their models, but he's driven by a supply side model, so he's just as model driven. So I tend to be more open-minded because I let the data guide me, and I do stake out a position and see if the data supports it or not. And I'm not wedded to any view. I tend to assign subjective probabilities to what is my base case is always obviously more than 50%, but I acknowledge the negative cases. But I think from a stock market perspective, the biggest advantage I have is I'm one of the few permabulls, which I view as a compliment. When people accuse me of being a permabull, I say thank you very much, and that's because I want my tombstone to say Ed Yardeni was a permabull, and he was usually right. because the market, I'm not bragging, I'm just saying that's what the market, recessions don't last long. There aren't too many of them. And the same thing can be said for bear markets. So I'm not too good at calling tops, but I'm really good at calling bottoms. And I view these corrections in bear markets as buying opportunities rather than reasons to get out. And I criticize the perma bears, and there are many more of them, for some of them are pretty good at calling tops, but they never tell you to get back in. So a perma bear, by definition, will never have you in the stock market. So if you listen to a perma bear, you're basically saying, okay, I'm not interested in stocks. So
it's easier to look smarter by predicting crashes and doom, and instead of saying everything's going to be okay in the end.
Yeah, I don't know anybody who's still alive that lived through the Great Depression and the Great Crash, but it seems to have had a traumatic impact on a lot of people today. And there was just a book written called 1929, and it really wasn't 1929. It should have been called 1930, because the so-called Great Crash wasn't so great. The market recovered 50% of what it lost by May of 1930. It was back to where it was in April of the year before. Now, if you owned a portfolio and over a 1 year period, it was kind of unchanged. Unless you bought at the very top, it was no big deal. But then they passed the Smoot-Hawley tariff, and the market went down 80%. That's when the Great Crash really started. But we've had a few significant bear markets, but I would say that the one that occurred in 2008 was the most traumatic that people experienced. And I think I don't think it would have been as bad as if there wasn't a policy mistake, which was a huge policy mistake, which was to let Lehman go on September 15th. And then the very next day, bail out Morgan Stanley and Goldman Sachs. We would have just had a pretty conventional bear market and conventional recession. But there was a huge policy mistake made. So anyways, that's a quick one for you.
Thank you so much. Let's start our journey with equities. For many years, you were a strong advocate of U.S. equities. Stay home for the U.S. investor was your basic advice, particularly overweighting large cap tech stocks. Since late 2025, you started to recommend a more going global approach, and you started to feel that the impressive 493 stocks, so the other one, except the Magnificent Seven, will eventually catch up. What's your view about it?
Well, we had been recommending overweighting the U.S., which we call stay home from our perspective, rather than going global since 2010. And it worked out really, really well until last year. And so last year we started to moderate our views somewhat, but we still kind of stuck with the idea that you wanted to be overweight the U.S., particularly the Magnificent Seven. And then I looked at the percentage of the S&P 500 that's in technology and communication services in the United States, and it got up to 46%. And so from a stay-home perspective, I was thinking, wait a second, I'm telling people to overweight these two sectors that already are basically overweight, accounting for 46% of the S&P 500. Particularly the Magnificent Seven accounted for about 33% of the S&P 500. Impressive. So I reduced my rating on the domestic situation from overweight technology and communications to market weight. That's still an extraordinarily large position in the portfolio at about 45% right now. On the other hand, the Magnificent Seven, I suggested maybe underweighting and overweighting what I call the impressive 493, because The Magnificent Seven are coming up with technologies that they have to sell to somebody in order to make money. And those technologies have to be very useful in increasing the productivity of their customers. And so I kind of view the 493 as the customers of the Magnificent Seven. Of course, that's a bit of an exaggeration because like in technology, and communication services, if I'm recommending market weighting those two, that doesn't mean that you underweight semiconductors. I have no problems overweighting semiconductors is staying with that. And that obviously has worked, especially these days with a shortage of memory. And then I looked at the market capitalization of the MSCI World Stock Index and recognized that the stay home had worked very well. And it had gone from, about 2010, I think it was about 35-40% of the MSCI to 75%, to 65% of the MSCI. And again, recommending overweighting the U.S. was recommending putting more than 65% of your global assets into the U.S. So I trimmed that back and I said, maybe 2025 really was a inflection point in this stay home versus go global thesis, and it was time to overweight the rest of the world. And it's pretty easy to overweight the rest of the world because the rest of the world only accounts for 35% of the MSCI index, with Japan and about 10-15%, 10%, emerging markets about the same. And Europe, I think about 15%. So it seemed to me that it's time to look for some opportunities overseas, even though we had that was the theme last year. I didn't think it was too late to play that. And I'm particularly keen on emerging markets. The emerging market world now has very rapidly growing and large middle classes. They want to prosper the way people have prospered in the developed world. And that's creating a lot of growth, a lot of opportunities.
With the pivot to China, some countries are trying to struck deal with China as a consequence of the TTT, the Trump's tariff turmoils. Are we onto something when it comes to investing in emerging markets?
Well, it's interesting. If you look at the emerging markets MSCI, particularly if you look at it in dollar terms, and when Americans invest in emerging markets through ETFs, they're all obviously in dollar terms. So you have the risks and the opportunity of investing in emerging markets in their local currency, but you also are combining that with the risk of what will happen with the value of the currency, the foreign exchange value of the dollar relative to emerging market currencies. If you look for the past 15, 20 years, emerging markets have had some spectacular returns, but then they give them all back. It's been a great trading vehicle, but it hasn't been a particularly good investment vehicle, especially when you look at China. And China accounts for a large percentage of the emerging markets market capitalization. And it may turn out that this is no different, that this will turn out to be a trading opportunity rather than a long-term trend. I'm open to that possibility. I'm not ignoring that possibility. But I think there is something more structural going on here that suggests that emerging markets can outperform. The other thing that's interesting is that the emerging markets index in dollars, the MSCI, if you put it on the same chart with the dollar, obviously it's going to be quite highly correlated. But if you put it on the same chart as commodities, it's very highly correlated. So there still tends to be a commodity aspect to emerging markets. That's obviously true with a country like Chile, which is copper. Brazil has a lot of agriculture, but also has iron ore. Indonesia tends to be a commodity-centric kind of emerging market. But now I don't know why we still call South Korea and Taiwan emerging markets. They emerged a long time ago, but they're included in the emerging market indexes. And they've obviously gone up tremendously just in the past year because South Korea is basically Samsung, and there's a shortage of memory. And so it's basically been an IT play. And Taiwan is basically Taiwan Semiconductor. And we know what that's all about. That's basically NVIDIA. So emerging markets, when you're overweight emerging markets, recognize that you're kind of overweighting commodities and you're also kind of overweighting AI. So if you're already overweight those one way or other, just be aware of the fact that be aware of that fact of the correlation with commodities, the correlation with technology. In other words, you can still invest in the U.S. semiconductors, for example, and not do South Korea by buying into an emerging market fund. But that's just a consideration when you look at your portfolio. Recognize that emerging markets may correlate very closely with technology companies you have and very closely with commodity companies you have.
Very insightful. Thank you. Back to the US. Last time we met, we discussed the roaring 20s scenario you correctly called back in 2020. Are you still confident in a productivity-led roaring 2030s scenario?
Yeah. Yeah. I mean, right now I'm still working on the roaring 2020s. We're already 6 years into it, and it's worked out really quite well. Real GDP is at an all-time high. Real consumption per household is at an all-time record high. Earnings are all-time record high. The stock market's at an all-time record high. So from the vantage point of what I have to get right, things have gone pretty well in terms of the financial markets and the economy and the global concept of overweighting the U.S. versus the rest of the world. Now we got 4 more years to go, and so far so good. I think last year was certainly a very strong productivity year, and that may continue. We've got very strong growth in real GDP without very strong growth in employment. Well, that implies productivity is booming. There's more and more evidence that AI is an important tool for increasing productivity. It's not the only one. I think a lot of companies decided to hold off on expanding their payrolls while they assessed what AI could do for their organization. And I think many of them have finished up that review and concluded that AI is helpful in some areas and not so much in other areas. But meanwhile, they've looked at their entire company and from a productivity standpoint. And so I think there's a lot of cleaning up that's been being done that may not even have any directly to do with AI so much as like, why do we still have this operation here? Why are we still doing it this way? So I think productivity is starting to show signs of making a strong comeback. Over the past 3 years, it's up like 2.5% at an annual rate. The average historically is 2%. I think we could be looking at 3 to 4% over the rest of the decade. And I mean, if the roaring 2020s works, it could continue into the roaring 2030s. Now, when I started talking about the roaring 2020s in August of 2020, that kind of looked delusional, but obviously it's working out so far. But a lot of people came back to me. The pushback was, well, the 2020s didn't end so well, and I kind of half jokingly I tell them, well, you better make a lot of money then now and then cash it in before the end of the decade, and you'll do fine in the 2030s. But I think that the reality is that if we make it, if it does turn out to be the roaring 2020s, there's no reason why that couldn't continue into the 2030s. Again, as my view is that the great crash of 29, really the great crash of 1930s when it really crashed. The Great Crash and the Great Depression were caused by the Smoot-Hawley tariff that was passed in May of 1930 in the U.S. And we just had a year last year where the economy was stress tested with tariffs. Both the domestic and global economy were stress tested, and they both did extremely well. And, the Roaring 2020s thesis helped me have the correct view, as it turned out, that the economy was resilient and wouldn't have an economy-wide recession, which was rather controversial to say the least, because the Fed raised the Fed funds rate from 0 to 5.5%. And I was saying, I don't think that's going to cause a recession, and everybody else thought it would. So I was betting on the resilience of the economy. I said we could have rolling recessions affecting some industries at different times, but it turned out the economy was resilient. So why wouldn't we learn from that and conclude that why wouldn't it continue to be resilient over the rest of the decade? And if it does, why wouldn't that continue to be the case into the 2030s? And a lot of the Roaring 2020s thesis was based on the idea that, like the 1920s, we have tremendous technological innovations that are increasing productivity and the standard of living. And why wouldn't that continue into the 2030s? At the same time, let me just say one more thing on that subject, and that is I do acknowledge that the 2030s could be bad. I mean, I don't dismiss the pessimists that are out there, and I sure hope that the 2030s don't start to look like the 1930s. And clearly, the geopolitical risks are there, pointing at that possibility. But a lot can happen between now and then. And I suspect we'll do a few more talks along the way, so we can assess that.
Yeah, and thank you so much for your view. In the classical investing textbook, you read the stocks are the risky asset and bonds the safe one, especially government bonds. Bonds are no longer what they used to be, or it seems like they are having a interesting time right now. They were once considered the ultimate safe assets, while now government bonds all around the world are facing growing skepticism due to rising debt levels, fiscal deficit, fiscal dominance in many countries. Starting with the US, do you think that these concerns about the treasury market are overblown?
No, I wouldn't say they're overblown. They are reasonable concerns to have with the U.S. debt at a record high, with the deficits of $1.5 to $2 trillion. President Trump is talking about next year raising the defense budget by 50% to $1.5 trillion. If interest rates don't come down much from here, even with a new Fed chair, we're still talking about at least $1 trillion a year in interest expense. So, no, it's a legitimate concern, but I think one has to be, again, data dependent. One has to be neutral when it comes to investing. Don't let politics get in your way. Don't let models get in your way. Don't get hung up on kind of one pessimistic story, particularly if it isn't working out. And a lot of people have been have stayed away from the stock market because they've been concerned about the government debt issue. And meanwhile, as we know, the bond market has been pretty calm of late, and the stock market is at an all-time record high. Look, Ricardo, I came up with the idea of the bond vigilantes back in 1983. And the idea is that if law and order isn't maintained in our economy and in our financial markets by the monetary and fiscal authorities, the people that we elected or that were appointed to maintain order, to avoid financial instability, to avoid financial crisis, if they don't do their jobs, then the bond vigilantes step in and and express their displeasure by pushing bond yields higher. So far, we really haven't had a debt crisis. People like Ray Dalio have been warning about an imminent debt crisis for quite some time. My view is I'll worry about a debt crisis when the bond market worries about it. Ricardo, let me tell you a kind of quick story here. I have a lot of accounts, and some of them manage money for very wealthy people. And wealthy people are very conservative. They like to keep what they earned, but they also want to return. And so the money managers that I talk to, that are my accounts, who manage money for wealthy people, are telling me that as the market goes up, these people are getting more and more worried. They're getting more and more bearish, and they want to get out of the market because they made a lot of money, and they say that's pretty good. Let's keep it. And so I asked the money managers, well, what are they worrying about? Said, well, they're worrying about government debt. They're worrying about deficits. And so I said, okay, so if you get out, what do they want you to put it in? They said they want me to put it in 10-year treasuries. So the world is becoming wealthier and wealthier. There's a lot of inequality in that, I recognize. Sure. But the fact of the matter is the world is becoming wealthier and wealthier. As that's the case, wealth seeks diversification. I think that explains why gold has done well of late, is because as people have made more and more money in the stock market, they do rebalance, which makes sense. They diversify and says, what asset can I kind of put some money in case the stock market goes down? And historically, gold and the stock market have been inversely related. Gold has been a good diversifier. Bonds have been a good diversifier. So there's a tendency to diversify portfolios. And so people do buy bonds, and they do buy gold, and they do buy land. And, that kind of explains why, especially now, we seem to be in a bull market in everything, because there is so much wealth. And as particularly stock markets create more wealth, there's more money to diversify into other assets.
Should we be worried about spillover effects coming from what's happening in Japan with their huge bond market, weak yen, and all the stuff going on these days?
Ricardo, the lesson of the roaring 2020s so far is that not only has the U.S. economy been surprisingly resilient, but so has the global economy. And when you look at how well the global economy performed last year in the face of Trump, what I call Trump tariffs turmoil, it's really quite impressive. And stock markets around the world have been rallying, sort of discounting that, kind of confirming that the global economy is doing well. I've been doing this for a while, and when I hear people worry about what's coming out of Washington, I kind of say, well, let's think about it for a second. Isn't it amazing how well the U.S. economy and U.S. stock market have done over the years, despite Washington? And the same thing goes on a geopolitical perspective. We've seen many geopolitical crises that turn out to be buying opportunities, not reasons to panic and put everything in gold or cash under a mattress. So the resilience of the U.S. and global economies, I think, are what the stock markets are in fact reflecting. And if that's the case, then I think we'll find that we can take these shocks without them kind of creating a Lehman moment, as happened in 2008. Again, I think that it was a total mistake to let Lehman fail one day and then the next day bail out Morgan Stanley and Goldman Sachs. If they'd bailed out Lehman, I don't think we would have had the consequences that we had. Now, with regards to Japan, I kind of view it as what they say about Las Vegas. What happens in Las Vegas stays in Las Vegas. So I think what happens in Tokyo stays in Tokyo. I know it could create problems through the carry trade. A lot of foreign investors borrow, at very low interest rates, what used to be very low interest rates in Japan, and the yen goes down, and they make then they take that cheap money and invest it in other markets. They invested maybe the Magnificent Seven or Brazil or wherever. They make money there, and then they have to pay it back with a cheaper yen, which is great for them. So it's conceivable that we'll have some sort of yen carry trade Lehman moment, but we've already kind of had that about a year ago. When the BOJ started raising interest rates more aggressively, and the yen showed some firmness. The people who play the carry trade, they're they know how to they know what the risks they're taking, and they know how to cover their positions very quickly. I don't think it's going to be a problem.
I read that some people are worried about upward pressure to global long-term rates. You have JGB starting to yielding more than they used to be. Is there ground for this concern?
Well,
Could be a problem for.
Yeah, it's again. I'm not dismissing any logical reason for worrying, but at the same time, my contrary instincts come up when everybody's worrying about the same thing, and at the same time, I tend to be empirical. Well, no, Japanese bond yields have gone up dramatically in the past couple of years, and nothing really has blown up. We haven't had a Lehman moment, and everybody, if everybody's waiting for a Lehman moment, we're probably not going to get one. Again, there's my contrary instincts coming out. But I think bond yields have just normalized. I mean, I think the bond yield that should never have been down to 0.5% in the U.S. It was manipulated by the central bank that was paranoid about deflation and was, creating what was basically manipulating the markets. I think 4 to 5% range for the U.S. bond yield is normal. I think that's where it should be. It's important to have capital markets with free markets that tell you what the market thinks interest rates should be, and that gives you a better allocation of investment capital. So I think that's where they are now. I don't see a situation where we've got the bond markets signaling that, or the bond vigilantes signaling that we're going to have an imminent debt crisis and that the whole thing's going to implode at this time. But again, I'm open-minded. If the markets tell me that there's an issue, look, back in 2023, the bond yield went up in the U.S. went up from 4 to 5% in 3 months. That got me a little bit. That got me a little bit concerned. And then it got to 5%, and Janet Yellen, the Treasury Secretary, said, "Okay, I get it. The bond vigilantes don't want me to increase my issuance of bonds. I'll raise more money through the bill market," and that calmed the bond market down dramatically. And now in the United States, we've got legislation that has authorized stablecoin, and stablecoin has to be backed basically by Treasury bills, which creates a whole new demand for Treasury bills. So the bond vigilantes are not the only participants in the bond market. There's central banks, there's treasuries, there's individual investors, and so on. And I think the thing to understand about debt is if it gets bought at an interest rate that the economy can live with, then that debt is somebody's wealth. The more debt, the more wealth. Where we could get into trouble is if we get into a situation where more and more debt leads to bond yields that the economy can't live with, that cause a recession, which then obviously worsens the deficit. And then how do we get out of that mess? And that's been a concern for a long, long time. When I coined the phrase bond vigilante in 1983, I went back and read what I wrote, and I wrote that the bond vigilantes were concerned about deficits of $250 billion in the U.S. Now we're talking about $1.5 to $2 trillion. The stock market's at an all-time record high.
Yeah. Reckoning is coming.
Yeah.
As far as the central bank is concerned, last week Donald Trump made his choice. Kevin Warsh is going to be the next Fed chair unless the Senate does something against it. And his plan is to lower interest rates as the president wants, and at the same time shrink the Federal Reserve's balance sheet. Is it possible to achieve both?
The honest answer is I don't know, but we're going to find out because Kevin Warsh seems to be committed to doing this. But I wrote up an article for the Financial Times on Warsh, and that was on Monday. And the title of the piece was that the markets are about to test Warsh. That whenever you get a new Fed chair, the financial markets tend to kind of stress test the Fed chair. Maybe that's just a coincidence, but that seems to be what's happened in the past. So he'll probably be tested. But then again, he may not be able to do what he wants to do. He's only one of a dozen voters on the Federal Open Market Committee. And I could see a scenario where his first meeting in June, the economy is absolutely booming. He recognizes that fiscal stimulus is very, very strong over the next few months because of last year's tax cut bill. There's going to be much higher refunds that people receive for taxes, and that could be very stimulative. In addition, the Fed has cut the federal funds rate by 175 basis points since late 2024, and that sometimes operates with a long and variable lag. So we could see fiscal monetary policy really booming the economy in the next few months. At the same time, I do think inflation is going down because of a productivity boom, but it doesn't have to go down in the next few months. We just saw a producer price index in the U.S., which was up 3% on a year-over-year basis. That was hotter than expected. And some of the data that's coming out also is already confirming that a boom is underway. We have something called the Purchasing Managers Index that comes out every month, and it came out for manufacturing. It increased quite significantly in January. A good weekly indicator for our labor market is initial unemployment claims. It's what people get as unemployment insurance when they lose their jobs. And initial unemployment claims have been coming down for the past several weeks, as of some other indicators in that release. And so the economy looks like it's going to be very strong going into the next few months. And so by the time Warsh comes in June, and if he wants to show to the president that he's doing what he wants and he votes for a rate cut, he may be the only dissenter, because everybody else might say, well, are you kidding? Economy is booming. Inflation's hot. Why would we possibly want to lower interest rates? And Warsh will say, well, it's because we're in a golden age. The administration has bought my roaring 2020s thesis back in 2024, early 2024. Bessent, who was still working for a hedge fund, quoted me and said, on the roaring 2020s, and said that's probably the kind of scenario that Trump wants. So, I'm very happy to see that I've got people in the administration that love my scenario, but I don't love their idea of lowering interest rates when the economy is doing this well. I think we've got to keep interest rates kind of where they are. So
you're saying you don't want interest rates at 1%?
No, I think that would be a mistake, because then, if you get a booming economy, you get inflation staying stickier at 3%, you get the stock market melting up, then you get a potential meltdown, you get financial instability. Why screw it up when everything's going so well, when there's no obvious need for lower interest rates? Why mess around with success? Why not let it just keep working?
Good question. One of the leading role in 2025 movie was performed by the US dollar. I read countless time about the end of the dollar dominance and the end of the dollar power in the last 12 months. But you always wrote about calm down. It's never gonna end anything. The dollar is doing just fine. Could you please give us your view about what's going on with the dollar and its movement, which was very sharp in 2025?
Well, basically it was down 10%, which is usually defined in financial markets as a correction. It wasn't a crash or anything like that. And a lot of that that 10% is when you look at DXY. DXY is the dollar index, and it's a strange index. It's basically the major currencies versus the dollar, and the euro's got a weight of 57%. So you're talking about basically say, oh my God, the dollar's going down. At the same time, you say, oh my God, look at the strength of the euro. I'm a little puzzled by the strength of the euro. I don't know that there's anything remarkable going on in Europe. I mean, remember in 2024, The Economist ran, I think, 3 consecutive cover stories, late 2024, basically about the exceptionalism of America. And like just in a matter of months, as Trump comes up with tariffs and he's beating up on allies, and all of a sudden, and the dollar's coming down, and all of a sudden, well, America's suddenly not exceptional anymore. And so is Europe suddenly exceptional? Is Japan suddenly exceptional? Is China suddenly exceptional? Everybody's got their issues and their problems. But the U.S. economy is still the largest economy in the world. It still have the largest capital markets in the world. It's the most capitalistic economy in the world. There's a tremendous amount of venture capital available to fund innovation. We're certainly leading in a lot of areas in technology, not to say that China isn't doing well also, but there's a lot that's still quite exceptional in the United States. The United States tends to be an exceptionally violent country. So, some of the partisanship and violence we see now are not that unusual, unfortunately. We did, for example, have a civil war. We've had race riots. We've had, Democrats and Republicans at each other's throats for a long time. And yet, despite all that, the U.S. economy has done very well. The stock market's done very well. And so I wouldn't bet against the dollar. And by the way, if things start to get uglier on the geopolitical scene, I would still think that a lot of people would be rushing back to the safe haven of the dollar and U.S. treasuries. And even now, when people say, "Oh, the dollar's going down," foreigners are bailing out of the U.S. It's the debasement, let's get out of the dollar. Well, again, I'm kind of data dependent. I follow the data, and the Treasury Department puts out monthly data on capital inflows from foreigners, net capital inflows. And over the 12 months through November, foreigners bought a record $700 billion of U.S. equities, and they bought a near record in the fixed income markets. They bought a near record $1 trillion in U.S. securities. So you just don't see any sign of panicking out of the U.S. dollar. That's through November, and the dollar was weak basically all last year.
Yeah, they hedged more the currency exposure, so that part of the story because of the downward pressure of the dollar if they buy U.S. assets, but hedge the currency.
Yeah, look, part of the story is the Trump administration not the Trump administration, Donald Trump wants a weaker dollar. Bessent, a few hours after Trump says, "I want a weaker dollar," Bessent gets on the news program and says, "No, we want a strong dollar." But, so there's a little confusion about what this administration really wants. But The good thing about a weaker dollar is it does boost our exports, and it just maybe creates some friction for imports. On the other hand, it's taken a risk that it'll create some inflation in the U.S. And it matters obviously to investing, because if the dollar is going to be weak, then that's another return you get if you have a dollar portfolio.
Sure. The dollar weakness, or whatever we will call it, is related somewhat to the meteoric rise of gold. And you forecast that gold could possibly reach $10,000 per ounce before 2030. And recently, however, we've seen extraordinary volatility. Gold surged to around 5,600 and then fell sharply to 4,300 last Friday. Worst day since 2013, if I'm not wrong. Now we are back to 5,000 on
almost 5,000
nearby. Yeah. How do you interpret this move? And what's your general take as far as gold is concerned?
Well, I have never in my career had an opinion on gold, because as a strategist, I don't have any way to value gold. I don't have earnings. I don't have dividends. I don't have coupon, any of that. However, that doesn't mean I can't have an opinion now. And when the price of gold rose above 2,000 to a record high in 2024, I said, maybe it's time to be bullish on gold. Again, I didn't have an opinion prior to that. And it was really quite simple. It was like central banks are buying gold. After Russia invaded Ukraine, we froze the foreign exchange reserves of the Russians. The European Union did the same. And so central banks, particularly of countries that don't share our values, so that would be, North Korea, China, Venezuela, until we changed the regime there, or seem to have changed the regime there. Russia, they're all been buying gold. And then, maybe sort of as a knee-jerk reaction to all the talk about debasement, other central banks maybe are buying gold as well. But we also have, I think, Indian investors have always liked gold and silver, so maybe they've been buying more. But I think that the big story has actually been Chinese investors, because Chinese investors lost a lot of money in the property market, and they're big savers. They save a lot of money, and a lot of them put it into property, and property values have collapsed, and they weren't getting any rental income because they were ghost apartments in ghost cities, and now they can't even sell the apartments, so they're hurting. And then in the stock market, they got whipsawed. Yeah, you have to be a trader to make money in the Chinese stock market. You can't just kind of buy and hold. At least that's been the story for about 15, 20 years. So now all of a sudden they see an asset which wasn't widely viewed as an asset class, but precious metals, they particularly see gold, they see it going up every day. And so I think a lot of Chinese investors have been jumping in there. And what happened recently on Friday at the end of January was that the CME Group, the Chicago Mercantile Exchange Group, which runs a futures market in gold and silver, raised margin requirements. They say, if the prices keep going up here, that just increases the downside. The more they go up, the more they can go down. So what do? They increase margin requirements, and guess what? The price goes down a lot. So silver went down by 30%. So that's a bear market in one day. And gold went down by 10%, which is a correction in one day. And now, they both seem to have shaken out the people who really couldn't afford to pay the extra margin. And now it looks as though we bottomed and we're going back up. The only real model, if you will, that I have for thinking about where gold is going to go if you put the price of gold on the same chart with the same scale as the S&P 500, going back to the 70s when the gold window was closed and gold became the price could move because Nixon went off the gold standard. Well, if you look at that chart, you'll see that the S&P 500 and gold are inversely correlated on a short-term basis. So gold makes a great way to diversify your portfolio of the S&P 500. The longer-term trend is about the same. So I think the S&P 500 is going to go to 10,000. And I can explain that with earnings. I think earnings are going to be $500 a share for the S&P 500 by 2030 at the beginning of the next decade. I think by the end of this decade, the stock market will be discounting $500 a share, and multiply that by a PE of 20, which I think is a reasonable multiple. If the economy continues to show its resilience and not have a recession, then you get 10,000 on the S&P 500. So I feel pretty comfortable with that as a roaring 2020s base case scenario for the stock market. And then looking at that chart, what I see, well, if that's the case, then probably portfolio diversification is going to, people will get nervous along the way as the market keeps going higher and say, well, how can I protect myself if something happens? And they'll be buying more gold. So that's the way I look at it. So 10,000 on the S&P 500 and $10,000 on gold by the end of the decade. This, by the way, doesn't come with a money-back guarantee, but it's my best shot at trying to explain where this could go in a roaring 2020 scenario. And the roaring 2020 scenario I have is, I give it a 60% probability, which after our discussion, people might say, oh, what's so exciting about that? It's not like 100%, it's not like 80%. Well, 20% that it'll be a melt up. In other words, it'll be too much of a good thing, too much roaring 2020s. And that would happen if Kevin Warsh is successful in lowering the interest rates, melt up, melt down. And then 20% that, things can go wrong, geopolitical risk,
black swan,
cause of recession, etc.
No financial advice, but would you recommend keeping a somewhat fair share of gold in the portfolios?
Yeah, I think gold has gained some legitimacy here. Maybe not so much because some people are comparing it to meme stocks. Meme stocks just go up even though their earnings don't justify it. And in the case of gold and Bitcoin, by the way, there's no earnings to value it. So, no wonder we've had some people say, hey, gold and silver are going to, and Bitcoin are going to zero, and others are saying it can go to 1 million. I try to be reasonable and kind of understand, what might happen based on what I know. And so, I think you should own some gold. On the other hand, I'm not a big proponent of Bitcoin. They say that Bitcoin is digital gold. I say that gold is physical Bitcoin, and I think the big risk in Bitcoin, the huge risk, is that at some point there will be the potential for quantum computing to hack the codes that protect you may open up your Bitcoin account, wonder what happened to your $2 million, and then what do you do if your account is gone? Do you go to your local police? Do you go to the FBI? I mean, if you lose money in a gold ETF and you think that something wasn't done right, the gold ETF is protected by government security laws. It's interesting, though. Trump said he was going to go and look at Fort Knox to see if it's really there, and I never heard of any follow-up whether it's really there or not. So I'm presuming it's really there. But the U.S. I think has about $2 trillion. U.S. government has about $2 trillion in gold.
To conclude, what is, in your opinion, the largest risk still underappreciated going forward?
For a European investor?
For European investors would be better for my audience, but what is your general view about possible risk looming?
Well, somehow I heard you say European investors, so let's stay with that for a minute. I think Europe has to listen to Mario Draghi. Mario Draghi, a couple of years ago, came up with a very good criticism of what's wrong with the European economies, but he also came up with some very good solutions to basically make Europe more competitive, reduce regulation, encourage the entrepreneurial spirit. I don't think he focused on defense, but clearly Europeans don't need me to tell them that they've got a problem with the Russian neighbor. I guess the risk for Europe geopolitically is here. Trump seems to be asserting the Monroe Doctrine that everything that happens in the Western Hemisphere is the responsibility of the U.S. and China and Russia have no business doing any business in the Western Hemisphere. So that includes Venezuela, it includes Colombia, it includes all Latin America, it includes Cuba, it includes Greenland, and maybe Canada. And so if Trump is bringing back the Monroe Doctrine with a Trump corollary, what about the Putin Doctrine, which is Russia is entitled to all of Ukraine and then more of Europe? What about the Z Doctrine that all of the South China Sea and the Taiwan belong to China? So there's a lot of geopolitical instability. It's concerning. I think geopolitics has become a major concern that investors need to worry about. Clearly, I don't think any of us would want to be in stocks if China suddenly invaded Taiwan. But I think the perception is that that's just not going to happen, not anytime soon anyways, and that some of these issues will be resolved one way or another along the way. I mean, one of the ways is, Taiwan Semi is building factories in Arizona. So maybe they're starting to hedge their bets about the possibility that at some point China invades. But I think we all have geopolitical risk. There's less stability in the global economy, and you can blame it on Trump, but I think we should also blame it on Putin for sure. We should also blame it on Z for sure. These leaders are not doing what they should be to create a global harmony. Instead, they're spending more on defense, and when you spend more on defense, it does kind of worry me. As I said before, I think the 2030s will be the roaring 2030s, but I do worry about the analogies with the 1930s, and there are plenty to worry about. For global investors, I think it's not just a risk for European investors; it's a risk for global investors. But I think the global economy continues to perform remarkably well despite the geopolitical uncertainties, and I think positioning a portfolio for that continuing makes sense, and going global makes more sense, especially emerging markets and selective areas in the European economies. If Europe deregulates some and creates more incentives for technological innovation, that could turn out to be an interesting area to invest.
Dr. Ed, thank you so much for all the invaluable insights.
May I, as a entrepreneurial capitalist, may I just let people know where they can try my research?
Of course.
So they could go to Yardeni.com, Yardeni.com, and that'll give you a choice of trying the institutional product, which is it's meant for institutions, and then there's the individual investor product, and so you can try whichever one you think might fit your needs.
It is not a sponsored episode, so I highly recommend it because I'm a heavy user, and it makes you 10 times smarter when you start reading
Thank you.
Yardeni's research. So thank you so much, and thank you so much for the time you dedicated to us.
Congratulations on your success.
Thank you. Bye bye.
Bye-bye.